Hey, good morning, everybody. It's Tuesday, February 10th, 2026. I, of course, am Hammer with Originator Success, Grab and Go Social, and Rate Sensei. Go check them out. They are products to help you, my Originator friends, get more loans in 2026. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time. If you're here this morning, say good morning in the comments. I don't see anybody saying hello yet, but I'm sure you will. And if you're watching on the replay, don't forget, do me a favor and just put hashtag replay in the comments. Lets me know how many people are actually watching. And if you are watching on the replay, I'm trying to speed it up a little bit. Let me know if you like that. Give me your feedback in the comments. I am not seeing anybody in the chat this morning. I'm going to turn it off, turn it back on, and see. I've had a lot of problems lately with Restream. It's been bugging out. I don't know if it's me. I don't know if it's the internet. I don't know. I don't get it. So anyway, if you're here this morning, say good morning. Remember, you can get a text reminder that I'm going live. If you don't want to miss the show, get that text alert. Go ahead and sign up at hmmr.io/reminder or use this cool QR code over here. Also, if you would like to start getting our written lock advice, you can sign up for that. Come on. That is at www.ratelockadvice.com. You can get email like this to your inbox each and every weekday morning with a quick advice at a glance and a recap and outlook for where we're at, and then the outlook for the next 15 days. Where do I think rates will go in the next 15 days, 15 to 30 days, and 30 plus days, and whether you want to lock or float based on that data. So go ahead and sign up for that. It's at ratelockadvice.com. I feel so lonely with the chat not working. I'm going to turn it off since it's not working. Why take up the real estate on the screen? I see your comments in the chat window. We just don't see them on the screen. So let me go ahead and turn them off here, and we'll see. We'll fix it later. But good morning, all. I do see you. And again, Ron Siegel said today is National Cream Cheese Brownie Day. Yuck. I don't know. Doesn't sound like something I would want. So anyway, all right, well, since we got the screen open, let's go ahead and jump over to what we've got going on today. Let's go ahead and get started. We'll do a quick recap first. Let me go ahead and bring up the comments, and here you go. So quick recap on what happened yesterday. Let's zoom into the bottom corner. I'm going to have to refresh the screen, and let's see. Oops. Nope. Hold on. There you go. And Percentify. There we go. All right. So taking a look down here, you will see this is everything that happened yesterday. Right now, mortgage-backed securities currently up about 10 basis points on the day. You can see that right about here. That's where we're at, which is a nice thing to be. That means we're going to see some slightly better pricing today. So taking a look, though, yesterday, mortgage-backed securities were right around 100 as pricing came out right around 10 to 11 a.m. Eastern time. That's generally when you see most lenders coming out with pricing. After pricing came out, we did see some nice improvement up through the morning, and that brought us up to about here. Green is good. We like to see green go up. That gives us a smile. So we did see that. And then basically that did hold through the day. Bonds ended the day better than when pricing came out, although there were only very, very few lenders, just a couple that actually repriced better on the day, not many at all. Taking a look this morning, we had a little bit of early volatility. Bonds opened the day big. When domestic markets opened at 820, we dropped. However, nice, strong recovery. We got retail sales data this morning. That was a little bit of a... It's stale data, though, because due to the government shutdown, the Census Bureau is still catching up. So this was December data. Retail sales unexpectedly stalled in December, suggesting consumers provided less firepower for the economy as the year drew to a close. We're going to get the January retail sales data. We'll get that next week on Tuesday, and that'll be a little fresher. But there was a decent reaction this morning to that data. You could see here mortgage bonds have they rebounded and have been improving through the morning. And they're probably not going to go much higher than what we see right now, up about 8 basis points. Um, Probably not going to go much higher than that today, maybe 12 or 13 basis points, but we're also not likely to go much lower. So reprice risk on the day is low. There's not much we have to worry about. One thing I do want to catch your attention, take a look at this 10-year treasury yield, 4.15, and most significantly, the 4.20 mark, which is right about here. It's actually a little lower. Like that was, let's see, this one didn't start at 4.20. Yeah. So the 4.20 mark is right about here, and you can see it's been a big deal, that 4.20 mark. And if we take a look at where things are at right now, if I move this over a little bit, so take a look. Yesterday, the 10-year treasury ended at 4.21, 4.21. I'm sorry, that was on Friday. Friday, it ended at 4.21. Yesterday, for the first time in a while, it ended right at 4.20, 4.20. So it wasn't able to break through, but after starting the day much higher, it did improve quite a bit. However, look at where it's at today. It's much lower. It busted through this 4.20. That has been a huge line in the sand going back quite a while. The 420, which is kind of funny. Remember how 420 used to stand for the weed smoking? But this is a big deal. If it closes below 420 today, we've got the jobs data coming out tomorrow at 8:30 a.m. Eastern time. Could really open the door for better rate sheets, better pricing. So we want to really keep an eye on that. Let me adjust this. We'll pull this over. Let's take a look at rate sheets together, and we'll get into that. Taking a look at rate sheets this morning, again, just really not much movement. There are definitely times where rates are more volatile, where they're moving around more, they're choppier. Right now, though, I mean, look at how consistent rates have been. Really, we're just trying to capture pricing, and that's what you want to be emphasizing to your borrowers right now, is that you're looking for windows to maximize pricing, and we may see small moves down in rate. Now, this week could be one of the better opportunities to see rates improve, because tomorrow we're going to have that BLS jobs data. If it does show some job market weakening, we could see rate sheets continue to improve. And then Friday, we're going to have CPI inflation data, consumer inflation. And if that shows inflation has started to cool off again, the tariffs have blown by, all of that, kind of behind us, that could be a really good sign. We could see rates improve an eighth of a point this week. And an eighth of a point in this market is kind of a big deal. That's why I had moved this week into floating, even on loans closing on the near term. I've been floating those. Remember, if you want to get the full email advice just for when you can't make it or things like that, you can sign up at ratelockadvice.com and get this email. But taking a look here, the advice at a glance, I would absolutely be cautiously floating anything that's closing in the next 30 days. I think that this week we could see enough opportunity for improvement that it's worth floating loans that are closing next week if you don't need to lock them to close. If you can squeeze a couple of days, how long? Let me know in the comments. I'm going to put the chat up on the side screen. Try one more time to load it. Let me try a different screen and see if this. No, don't use that QR code. I don't even know that QR code. I don't even know how that QR code exists. Let me put something else in its place and get rid of it. There we go. I'm looking to see if I can activate the chat on the stream here. It's not, nope, doesn't matter. It's not showing up over there. But let me know in the comments how long do you have to lock a loan before closing? Jane Bale said, Hammer, what are my thoughts about the dollar losing value and how it affects rates? I can get more complicated on that, but at the end of the day, it's not really having a direct, immediate, profound effect on mortgage rates, in my opinion. It's not affecting mortgage bonds. Rate sheets are absolutely going to reflect what we see going on here in mortgage-backed securities. You can see that mortgage-backed securities have improved. They're moving up. Remember, we want mortgage bonds the pricing to move up. The better it prices, it's just like your rate sheet. You get better rebate pricing. So the more this moves up, the better. The dollar is reflective of many things right now. And it's also not just economic, but it's almost, I think it's gotten more political and geopolitical than normal. So the dollar and the lowering of the dollar, I don't think we really have to worry about that hurting mortgage rates, Jane, is my answer to that. We see the chat when you put it up. You see it, but I don't really. All right, well, let me pop it up here. So you see it on your screen when I have it up here. That's crazy because I don't see it. So anyway, but I can see it if I look on the other window when it's on there. So Randy said the time frame varies between refi and purchase. So, I was asking you guys, when do you need to lock a loan? If the loan closes on Friday of this week, do you have to lock Thursday? Do you have to lock today? Do you have to lock Monday? When do you have to lock a loan in order to get the paperwork done so that you can close? I'm just curious about that. It's probably changed. Remember, when I wrote loans, I used Dinosaur Bones to sign the 1003, and we used good faith estimates. So it's been a while since I've written a loan. I like to kind of get from you guys where we are. So yeah, all right. I'll leave the chat window up. Thanks for letting me know that. It's so weird. I'm so many glitches lately. I feel like Star Wars. It's like technology is always glitching. So anyway, taking a look at what we've got. One thing I do want to kind of keep an eye on before we get into tomorrow's jobs data, that's going to happen at 8:30 a.m. So we're going to talk before then. Let's take a look at the Fed watch and take a look here, right? So Dora said a week before is enough. I do a lot of teens in 20 days. Yeah, I would think you got to lock, at least a few days before. And that's why when Derek said 7 to 10 days. Good morning, Dion. Great to see you there, my friend. Hope you're doing well. And so anyway, yeah, that's why, if the loan's closing on Friday, I don't think you're floating into tomorrow's jobs data, but anything closing next week. Remember, bond market closed on Monday. Lenders, not a rescission day. It is a federal holiday. Lenders will be, most lenders are closed on Monday. I will hopefully be having some fun after snowmobiling. So taking a look here at the expectation of a Fed rate cut. March meeting, it's now an 80% expectation that rates will stay the same. Heading into April, that drops now. Look at this. It's down to 60%. And compare that to where we've been. I mean, it was up a week ago. It was 75%. So markets are starting to price in this idea that the data is going to force the Fed's hand before Jerome Powell steps down in May as Fed chair. The expectation before was we would not see rates move lower until Powell was out, that Powell would influence to keep things the same. But look at this. A week ago, yesterday, today, we are seeing a big step down here. So after tomorrow's jobs data, we want to see if that goes even lower. I don't think we would expect to see a March cut. This may go, the March cut has also changed. Look at this. It was 90%. It's down to 80%. But by April, I think we could really see expectations of a cut grow. And all of this will contribute and kind of correspond and happen at the same time as rate sheets improving. We're not likely to see rates drop tremendously, but I think we could see an eighth of a point, even maybe tomorrow if we get some weakness, if unemployment goes up, depending on how markets react. It's not just the data, it's how markets react to the data. And I think we could be there. So yeah, Charlie said needs to be locked for the acknowledged CDs. So 4 days prior to closing. That's why most of the time, anything less than 15 days, you're only looking at like a week. So that's why I usually am in a lock stance. But right now I'm in a float. Holly said you have a minimum of 3 days you have to disclose CD with it locked, but normally a week, 10 days prior. Yeah. And that's what I find most people. When I asked about my written lock advice a while back, I had a few people that were like, you never change the lock in 15 days. And I'm like, because unless things are really, really looking good, you don't want to float those. You've got no time. So anyway, taking a look at what we've got going on here. I think we could see things improve. A couple of articles, by the way, that caught my eye this morning, and let's see if I can grab them here. This one, bond investors betting on 100 years of Google. It's rare to see bonds this long. They're not for normal investors. They're generally institutional investors, insurance companies, things like that. They like to invest in these ultra long debt. Like it says here, pension funds and insurers love ultra long debt because it matches with their long term liabilities. But if you're banking on that, you're banking that there's going to be that they're going to be around. It's interesting. By the way, they were selling their debt in sterling and Swiss francs, not US dollars. These are not American. These are in sterling and Swiss francs. They're doing bonds. So, drew a record 30 sterling billion of bids, I guess. So that's pretty crazy. The other thing here was another thing talking about Warsh. Trump says Fed pick Warsh. It's I'm going to have fun with the wordplay. We're going to say it's all going to come out in the Warsh. Trump says Fed pick Warsh can get economy to hit 15% growth. Now, there's a few things going on here. Number one, there's still drama surrounding the lawsuit, Department of Justice, and Powell. And, Warsh is not likely to get Senate confirmation until all of that's been dealt with. Trump's comments suggest he's betting Warsh can fuel the economy ahead of midterm elections, which, remember, that's in November. But Warsh's Senate confirmation may be delayed due to a Justice Department probe and the Fed building renovation project. So we'll see where all that goes. Getting Warsh in here, and the idea that he could get the economy to hit a 15% growth, that would absolutely that would be signs of a hot economy. And I don't know that that's great for mortgage rates. We'll have to see kind of how this would play out, because remember, mortgage rates do better in a weak economy, not a strong economy. We're looking for weaker economic conditions, weaker labor market conditions. If you have an economy that is, heating up and on fire, that means that you've got more productivity. You need more people. There's more jobs. These are not generally things that would push rates lower and push mortgage rates lower. So, it's kind of, we'll see where this rolls with all that. So Derek said he sees a CPA firm saying they think the jobs will be good or strong. What do I think? I don't think it will. I think anything can happen with this data, let's face it. But I don't think that it will be strong. Ron Siegel can attest. There's too many outside sources pointing to labor market weakness to think that there's going to be signs of strength. And even if it did, let's say that the numbers did come in strong. Look what happened last time. We get a ho-hum reaction. Markets, we don't have to worry. That's why I'm floating into this jobs report, whereas normally I would be locking. The reason that I'm floating into this one is because even if we did get signs of strength, there's a whole nother report before the March 18th Fed meeting. So markets aren't going to overreact to this data. They'll find a way to kind of push through it. I don't think we really have to worry about that right now. It's not something I would be. Ron Siegel, 15% growth is a typical embellishment. Yeah, absolutely. If we saw 15% growth, man, it would be crazy times. So, all right, my friends. Well, thank you again for joining me today. Tomorrow, we'll talk about what's going on with that jobs data. Make sure you're here. You don't want to miss that. Join me live each and every weekday morning. Again, you can sign up for those text alerts. If you want to know what's going on, check those out at ratetextalerts.com. If you want a text reminder for free that I'm going live so that you can join me tomorrow when we talk about what's going on with the labor market, when we talk about how that BLS jobs data comes in and kind of prep for Friday's CPI numbers, make sure you sign up at hmmr.io/reminder. All right, I'll see you guys tomorrow, and we'll have something fun to talk about. Take care, everybody, and make it a fantastic day. Bye-bye.